Hello, my name is Steve Orr, and I serve as Texas Capital's Chief Investment Officer. I'm here to address a vexing question. Why are interest rates rising after the Federal Reserve lowered short-term rates? It's a reasonable question because most people assume that everyday borrowing rates will drop when the Fed drops the federal funds rate. The short answer as to why rates are rising after the Fed cut rates is bond markets look ahead and they try to handicap what they think will happen, just like the stock market does. Now for the long answer. Let's start with a quick recap of what the Fed has been doing with rates since the pandemic. Now, during the pandemic, the Fed lowered interest rates to near historic lows to keep the economy afloat. Then when the economy began to recover, inflation kicked up fast. To keep inflation in check as much as possible, the FOMC began to raise rates, starting from 1/4 of a point in March 2021 all the way up to 5.5% by July 2023. Rising rates had the intended effect of cooling the economy. With the economy cooling, the current rate cut cycle started this fall with September's 0.5% cut. 2 more 1/4 point cuts followed in November and December. Today, the overnight range for Fed funds is 4.25% to 4.5%. So, where will the Fed stop? Think Goldilocks. Not too high a rate to choke off the economy, not too low to increase inflation. No one knows what that mystery rate is. We think it's probably 4% to 3.75% at the end of next year. That is reasonable. The current rate cut cycle began when the Fed cut rates in September. Longer-term rates bottomed and began rising on September 18th, the day the Fed cut. 5, 10, and 30-year Treasury bonds rose by over 0.5% by mid-November. In each of the 6 rate cut cycles since 1980, longer-term rates fell as the Fed cut short-term rates. Why is it this time different in 2024, with longer-term rates going up, compared to the last 6 rate cuts going back 44 years? Well, very rarely is there just one reason why markets move. Rising longer-term rates reflect several forces and worries at work. First, the Biden administration has pumped over $6 trillion into the economy over the last 4 years. Placing dollars directly into consumers and business hands has pressured prices higher. Inflation runs in waves, and markets see a second wave coming in the next couple of years. Higher inflation erodes the value of bond interest payments, so bond prices fall. That raises yields. Second, after the election, traders believed that the new administration and Congress would enact more spending, not only on different priorities, but at larger amounts. President Trump, though, has appointed 3 House members to his cabinet, shrinking the Republican majority. This should make it a bit tougher to enact spending and tax proposals. So long-term rates have come down just a little bit. Third, paying off the new federal debt with higher rate debt. Most of us like to refinance when interest rates fall, but $15 trillion of the $36 trillion, nearly 50% of the federal debt, comes due in the next 24 months. Now, the average interest rate on the old debt, taken out before the Fed started raising those rates in 2021, that rate's about 2.6%. The new debt to replace the old debt is going to average above 4%, or a 53% annual increase in interest payments. Already our interest costs on the federal debt are greater than our defense budget. That's a first in modern history. The market's opinion on what may happen is constantly changing, though. Just 3 months ago, markets thought the Fed would cut rates all the way down to 3%. Now they think it's about 4% over the next year. But the fears of higher inflation and spending by Congress are understandable. If the Fed cuts short-term rates too low, those inflation fears will rise as the Fed makes borrowing easier. Finally, there's 2 pain paths that would drop interest rates by a lot. Number 1, less spending and borrowing by Congress. Number 2, a hard recession that would see our economy stop growing briefly. We would prefer the short-term pain of path number 1. Another path would be world events, such as a collapse of governments and/or wars spreading. Neither of those are desirable. The 40-year cycle to lower interest rates is over. and we're now in a 40-year up cycle. Fortunately, the odds of being in the teens, like the early 1980s, are very low. We see interest rates staying in the 3.5% to 6% range for some years to come. We have a range of tools to help you control borrowing costs. We welcome the opportunity to assist you in navigating the markets. Thank you.